Happy Tuesday. I hope everyone is just having an ecstatic, exciting Tuesday. It's best day of the week, and as far as I'm concerned. And one of the reasons that is because it is Tax Tuesday. And well, first off, my name's Luke Robinson, and I'm a member. Not a member of Collective. I'm an employee of Collective, and more specifically, I'm a business advisor here. So it's my job to just go through a potential member's situation and see if Collective would be a good fit for them. And what we do here is we're a one-stop shop. We're an all-in-one sort of back office solution for self-employed entrepreneurs. We will form your business, form your S corp more specifically. We'll handle your payroll, your bookkeeping, and your taxes at the end of the year. But today we have something called Tax Tuesday. And essentially it's an AMA. It's an Ask Me Anything session about taxes, surrounding your self-employed business. How do you run the business properly? What are some financial best practices? What are some, best practices for taxes to keep in mind? Any sort of questions you have, just please bring them at me and I'll do my best to answer them. And really quick, just to kind of get the legal stuff out of the way, this is for information only. Don't consider anything that I say here actual tax or legal advice. Before you take any sort of, like official action on any of the advice I give or things I say, it's important to consult with a CPA, a tax attorney. So just keep that in mind. But let's go ahead and get started. And I believe that we already have some questions that have came in. And the first one, and apologies, I'm in sunny Florida. Well, today it's not so sunny. It's actually pretty stormy and the wind is blowing like crazy. So if the internet just combusts and goes out automatically, I apologize. But I think that we'll be okay for the time being. But let's go ahead and start on some questions. And Shannon has an excellent question, such an intuitive question. And it is, when you pay quarterly taxes, and when she says quarterly taxes, she means estimated tax deposits, tax payments that you make directly to the government each quarter. Do you record that in your expenses for bookkeeping? No, you do not. So first off, bookkeeping and an expense in bookkeeping is just that. It's a business expense. It's an expense that is, ordinary and necessary to run your business, like the business supplies, marketing cost, things like that. However, a quarterly tax payment is not a business expense. It is a personal tax payment. So you're only taxed on your net income, which is essentially, your total income minus your expenses. Then you get your net income. You put your tax rate to that net income to figure out your taxes. And you pay those taxes. One of the ways you pay those taxes is through quarterly taxes, estimated tax deposits. You go online to the IRS website every quarter and you pay them directly. But that's for your personal taxes. That's just to cover your income tax, your self-employment tax, anything like that. But it's not a business expense. It's not something that you can write off from your income because you've already done that. You've already done all of that to come up with your net income. Great question, though. Okay, here's another great question. I have rental properties and also my soccer store. I do a sole proprietorship. What is the best way to handle my taxes? Well, that depends. It depends on your situation. But there are some just kind of quick sort of guidance that I can give on a situation like this. For one, and again, I'm not a lawyer, so don't take this as official advice. And before you do anything, it's important to consult with a lawyer. But for example, rental properties. There's some I guess good practices when it comes to rental properties. One, it's important to have rental properties under an LLC. That's really important because, rental properties, especially when you have tenants in them, is that exposes yourself to liability, that exposes yourself to risk. And if you have rental properties that are outside of an LLC, let's say if a tenant sues you, someone falls and breaks their hip in your rental property or something like that, they can go after your personal assets if that rental property is not under an LLC. So that could be financially devastating in certain situations. So first and foremost, LLCs under a rental property. That's really important. But something else to go a little bit deeper into it, what you should, because a lot of times people will have loan balances on rental properties. They'll have a loan from a bank on them. So they might have equity in certain properties, meaning, let's say that someone has a $200,000 loan balance on a rental property, but that rental property is worth $400,000. That rental property has $200,000 in equity. What you need to do with the LLCs is you need to group rental properties under separate LLCs from one another that have high amounts of equity. So, and here's the reason why. If let's say that you have two properties, and let's say that you have one property is worth $300,000, and it's worth $300,000, but you also have a $300,000 loan balance on it. There is no equity in that property. So when a property is under an LLC, people can typically only go after the value or the equity in the property. They can go after the cash flows in certain situations too, of course, but really where they can get a lot of value from suing you and getting money from suing you is if you had a lot of equity in a certain property. They can go after that equity. Let's say, for example, that you have a property with no equity in it, and you have another property with a lot of equity in it. Let's say that you have, $200,000 in equity in a certain property. And let's also assume that those properties are under the same LLC. Let's say that something happens, like someone falls or someone sues you for some reason for something that happened in the low equity property, in the property without any equity. Since they're under the same LLC, that tenant can go after the equity in your other property because it's under the same legal entity. They have a right to that equity and to extract from it. So that's really important, is when you're putting properties under LLCs, group them together by the amount of equity they have. If you have, a couple properties that don't have any equity in them at all, it's safer to put them under one LLC, under the same LLC. But if you have other properties that have high equity, set up other LLCs and properly sort of transfer them to separate LLCs. Oh, and real quick, for your soccer store. And I think each house has to have an LLC. Each house doesn't have to have an LLC. No, you don't have to have an LLC for any rental properties, but it's advantageous to have houses under the LLCs. And each house doesn't have to have their own LLC, but group them together by lack of equity. If they don't have any equity, it's a little bit safer to put them under one LLC, but separate out the properties that have high equity into separate LLCs. And that comes to my next question, is what are some tax loopholes we can take advantage of? Well, unfortunately, loopholes kind of get over exaggerated. There isn't a lot of loopholes in the US tax code for, small business owners. But there's a tax strategy that you can take advantage of. And that strategy is an S Corp election, is to become an S corporation. And that's what that's what we specialize in. And essentially, and this will kind of go back to our previous question too, of the gentleman who asked, what should I do with my soccer store? If you are making a certain amount of money, and if you're in a certain sort of situation, of course, an S Corp election might be advantageous for you. And the reason I say that is the entire reason, before you become an S Corp, let me start off this way. Before you become an S Corp, let's say that you're a sole proprietorship, you're an LLC, something like that. A huge chunk of your money is subject to the self-employment tax. For most people, all of their money, all of their net income is subject to the 15.3% self-employment tax. It's a hefty tax. So let's say, for example, let's say that you're an LLC and you haven't made any sort of S corp election or anything like that. And let's say that your net income is $100,000 a year annually. Before you become a S corp, before you make an S corp election, all of your money is subject to the self-employment tax. So how you come up with it is you take 100 grand and you'd multiply it by 15.3%. That's how you come up with it. But when you make an S corp election, which that's another important thing to remember, is that it's a tax election. You'll make an S corp election on an LLC. So when you do that, and that's done with the IRS, by the way, that's done with the feds. And essentially what happens is an employee-employer relationship is essentially formed between you and your own LLC, your own business. You're still the owner. You're still listed as the owner, on the company formation documents and whatnot. But for tax purposes, you literally become an employee. And since you're an employee, you pay yourself a salary. Your business will pay you a wage just like you'd receive if you work for someone else as a W-2 employee as well. But the financial advantageous thing about S corps is that the only chunk of your earnings that's subject to the self-employment tax is your salary, whatever you choose to pay yourself in W-2 salary. So, for example, going back to my earlier example of making $100,000. Let's assume in a situation like that a reasonable salary for you is $40,000. It could be different, could be higher, could be lower. The salary kind of has to do with your personal sort of situation. But let's just assume it's 40 grand. Now, only that first 40 grand is still subject to the self-employment tax. The other 60 grand is now considered distributions to yourself. You can kind of think of it almost as dividends, like kind of conceptually speaking. People sometimes will use the word distribution and dividends kind of synonymously. But long story short, that chunk of earnings, your distributions, are no longer subject to the self-employment tax at all. So, in a situation like that, assuming that your distributions are $60K, you're saving $9,180 per year in the self-employment tax. How did I come up with that number? I took 60 grand and I multiplied it by 15.3%. That's how you come up with the tax. So, once you reach a certain income level, then an S corp election can be, quite advantageous. And so, I mean, that kind of answers the question of what are some tax loopholes. An S corp is not a loophole. It's, right there concretely in the tax code. But it's certainly a advantage that you can take advantage of. Any quick facts for filing taxes in 2024? Well, one quick fact is your fourth quarter 2023 estimated tax deposit is due on January 15th. So that's one quick fact, is to go ahead and get, like, if you kind of have an idea of how much tax you owe, in general, then that's that's a date to keep in mind. Like, to prevent a penalty or anything like that, it's important to get that fourth quarter estimated tax deposit in by January 15th. Something else, of course, and another kind of quick obvious fact, is to file your return, or do the best you can to file your return by April 15th. And if you're not able to file your personal return by April 15th, then you need to file an extension. An extension gives you an extra 6 months to file your personal tax return. So that's one thing. However, it's important to keep in mind that an extension doesn't give you more time to pay your taxes. It only gives you more time to actually file your return. So if you don't, like, for example, let's say that you owe a certain tax balance. Let's say that you owe $20,000 in taxes in 2023. If you file an extension on your tax return, it prevents failure to file penalties, which can be really steep. It does prevent those penalties up until the extension deadline. However, it does not prevent failure to pay penalties. Doesn't matter. Even if you file an extension on your tax return and you owe money, then doesn't matter at all. They will still charge you failure to pay penalties. And those aren't fun either, believe me. I haven't filed my back taxes. What should I do? Well, here's really quickly what I would say. It's more important, um, I guess I use the analogy to kind of stop the bleeding. And it's more important to file your current taxes and to get current, to make your current estimated tax deposits and make your current tax return compliant and on time than it is to file your back taxes. Because typically, the IRS only require, and this is generally, the IRS only requires the past 6 years of tax returns. So for example, if you're missing, 10 years worth of tax returns, a lot of people think they need to scramble and file the last 10 years, but no, you typically only need to file the last 6 years. Those other 4 returns previous to the last 6 years, they typically won't even require those returns. So it's more important to go ahead and get current to stop the bleeding. Also, because if you continue to just stop filing your returns and you just don't ever file them, you're just going to continue to owe. Your tax balance is going to continue to grow and grow and grow. However, your current tax balance or any taxes you owe in the past, there is this 10-year statute of limitations for the IRS before them to even collect on your taxes. It's called the CSED dates, collection statute expiration dates, to where if you don't, there's a certain date, and it's usually 10 years from when the tax is assessed on you. So whenever that tax hits your account as being owed, they usually only have 10 years to collect on that tax. And if they don't collect on it in 10 years, it drops off. It goes into the abyss and it drops off your account and you don't have to pay it. Now, there are certain things that can toll that 10-year statute. When I say toll, I mean pause it. Things like bankruptcy, things like a settlement agreement with the IRS, or otherwise known as an offer in compromise. If that's sort of processing, that typically tolls the statute or pauses them. So, real quick advice, file your current taxes first and then deal with your back taxes. How important is it that I file my LLC BOI report? It's extremely important. Now, and again, this is very new tax law, so I'm a little rusty on it. So again, do not take this as honest truth, but I believe that any sort of LLCs formed previously to 2024, any LLCs like before January 1st of 2024, you have until 2025, I think the beginning of the year until 2025 to file your BOI report. However, it's important to just do it as soon as possible. That's the best practices, because I'm not even really sure if that's correct, but I believe it is. I just don't have enough time to look it up right now. But it's extremely important because actually it can be a criminal matter, I believe, if you don't file that report. Like the government wants to know, and it's pretty unlikely that they would take any action or anything, I would say. But they could penalize you if you don't file that report. They could do other things to you. So it's a good idea just to file that BOI report as soon as possible. Are there any books or podcasts you'd recommend to read or listen to increase our tax knowledge? Well, honestly, I don't. I guess I would say I'm a tax expert myself, so I don't. I've got a lot of my experience just working in taxes and whatnot. So, but however, I work for a company that has a lot of great resources. Collective. Go to collective.com and check out our blog page. We have tons of great blogs, like tons of great articles walking through all kinds of sort of tax situations. Visit our Instagram page. Go through and find out some information there. And something else I would encourage you to do too is if you think an S corp might be beneficial to you, or you're, kind of interested in optimizing your tax situation, feel free to schedule a call with one of our business advisors. You can go to collective.com, schedule a call there. You can send us a message here on Instagram, and we'd love to have a conversation with you. Oh, okay. Here's a good question. If a job requires a college degree, can we somehow write off the cost of our college degree as a business expense? No. You generally can't write off the cost of your college degree as a business expense. Now, you just can't. I mean, typically, typically a college degree is for personal reasons. You're trying to just sort of further your personal credentials. Like technically, that isn't a business expense. However, if you're self-employed, the rules are a little bit different. So self-employed individuals can deduct education expenses if the education maintains or improves the skills like in your existing business or trade. But the initial education, like a college degree or something like that, that typically isn't deductible. But let's say that you're, doing continuing education credits, continuing classes, like after your college degree and whatnot, just to brush up on your knowledge. That typically can be a business expense. Yeah. All right, we got several more questions here. What should be on our 1099 checklist? So that's an interesting question. Well, first of all, a 1099 is essentially how you report how much you've paid to a contractor, essentially. So let's say that you've hired someone on a 1099 basis. You have a contractor. If you've paid them $600 or more in sort of non-employee compensation, which means they're a contractor, you are required to file a 1099. So that's one thing. It's just the checklist is, how much have I paid this person? If it's over $600, then it's important to file a 1099. And there are other things that you need to file the 1099. One is the recipient's legal name. You need that. You need their address. You need their taxpayer identification number. So that can be, their social security number or their EIN number. But those are the two, I guess, like two sort of main sort of checklist items that you'd need to when you're thinking about filing a 1099. Is it smart to outsource your taxes? Yes, it is. It's extremely intelligent to outsource your taxes. And one of the reasons that is, of course, is because the tax code is complicated. The US tax code is extremely complicated in the sense to where, especially, if you're a self-employed person, it's hard enough to run your own business. It's hard enough to know all the information in your own craft and trade. But the US tax code is a whole different bear. So yes, it's extremely important to outsource it. Outsource it to a professional that can optimize your tax situation and can very likely, keep you in compliance and save you more money than you could. All right, we've got several more questions. Let me see here. Is it smart to put all of my side hustles into LLCs? Well, it depends. It depends. Just in general, like just kind of quickly saying it at a glance notice, if you have some sort of business operation, side hustle or not, it's usually a good idea to put it under an LLC. Just in general. However, there are some situations in certain industries to where it's less important to form an LLC. And really what you got to keep in mind with that is, first off, an LLC, like the entire reason for it is to separate your business life from your personal life. Is to separate your business finances from your personal finances. So, like, for example, when you set up an LLC, you can set up separate business bank accounts that are registered to that LLC. So that's one thing, is it just kind of separates your finances. It also provides certain protection from litigation and certain, sort of legal liability protections that you have. Let's say that your business gets into a lot of, business debts or, anything like that. typically creditors and other organizations don't have a right to go after your personal assets or personal income when something is under an LLC. But if you're a sole proprietorship or anything like that, they certainly can. They have the legal right to do that. Now, I will say though, the less litigious your industry is, the less important it is to file an LLC. Because some states, like New York or California, it can be a little expensive to run an LLC. California has an $800 a year entity tax they charge on LLCs. New York has franchise taxes and some sort of LLC specific taxes that they have. So, if you're in an industry where you're comfortable to not have an LLC, meaning it's not very litigious and you're just not, all that worried about getting sued, then it's more likely less important to have an LLC. But I'm not telling you to not form one though. Like usually it's a good idea to have one. What's the difference between a C Corp and an S Corp? Excellent question. So first off, what I'll say is that a lot of people have a misrepresentation about what an S Corp actually is. An S Corp is not a business entity like a C Corp. It is not a corporation necessarily. An S Corp is a tax election. It's a way for a business entity to get taxed. So, like for example, if you're a sole proprietorship or just an LLC, all of your money is subject to the self-employment tax, essentially. Making an S Corp election mitigates that. It kind of helps reduce that. Let's say that you're a C corporation, though, which is the original question here. A C corporation is just what it is. It's a corporation. It's a corporation that you file with your state. You are now a C Corp. And if you don't make an S Corp election on that C Corp, of course, you remain a C Corp and you have double taxation. You're taxed at the corporate level, at the C-suite level. The corporation itself actually has an income tax. And then you're paid at the investor level. Then you're taxed at the investor level. You're taxed when, people are paid out in salaries, when dividends are paid out or other things like that. That's then taxed again. But how you prevent that, and you make an S Corp election on that C Corp, and it converts it into an S Corp instead, or it converts it to a corporation with an S Corp election. And that actually turns it back into a pass-through entity, just like an LLC or a sole proprietorship is. And you go on a salary, you become an employee of the corporation, and the only chunk of your earnings that's subject to the self-employment tax is your salary. The rest are dividends, and there's not any sort of special corporate tax or anything on your dividends or distributions. Okay. All right, I think I have time for a couple more questions here. And let's see. What are some common business expenses that people write off that they're not supposed to? Ooh, well, that's a fiery question there. The one that I think I probably hear about the most are meals. A lot of people are writing off personal meals as a business expense, and you can't do that. Now, there are certain situations where you can write off meals, a meal with a client, business meetings, like typically you can write off half the cost of the meal. However, if you're just at a coffee shop and you're thinking about business, or even if you're like kind of working on stuff, or if you're not having that meal specifically because of your business, if that meal isn't in existence because of some sort of business meeting or anything like that, you are not supposed to write that off. And unfortunately, I hear all the time about, people just writing off meals just because they're thinking about their business. That isn't allowed. But unfortunately, that is all the time that I have left. I have a conversation with a collective, but potential collective member actually. So I'm going to have to leave you guys. But like I said, please, if collective seems like a place that might be useful to you, or you'd like to learn more about the S Corp, please schedule a call with one of our new business advisors, and we'd be happy to have a conversation. But I will see all of you next week. And it was another very enjoyable Tax Tuesday.